Hello and welcome to Fireside with the VC. My name is Andrew Romans, and I'm really pumped to have my old friend and good friend Kelly Perdew, founder and managing partner at Moonshots Capital, on the podcast. Kelly, great to see you, man.
Good to see you too, Andrew.
So I'll do a quick intro, and then Kelly can explain how he runs his business and his background. But Kelly is serious military man, man of action, West Point grad, double UCLA, I think, MBA and all that. But you ask the guy to do something and he just fires it out like bullets. He must have been CEO of something like 5 VC-backed companies. I met him when he was running a DFJ-funded company. He's also married to a woman that reminds me of the TV show Mad Men, where she keeps starting the company and selling it to the Brits. So, it must be an exciting dinner table every single night there. And he more recently went from entrepreneur operator to VC. It's been a while now. I think we're coming up on getting towards 10 years, or at least 8, with Moonshots Capital, which he co-founded. And we're going to talk about how to raise money, how to start a VC fund, and be successful, all that. So Kelly, great to see you.
Thank you for that inspiring introduction.
Yeah.
Good to see you too.
So I want to get into your strategy and how you built the firm, but you're in a good position to give advice to a founder on raising capital. I mean, how many VC-backed startups were you the CEO of?
2 venture-backed, and then
Okay.
three or four bootstrapped. But all in all, I've been in the seat or next to the seat in 10 operating roles.
Right. I mean, like, how many times have you pitched Tim Draper?
I have pitched Tim Draper several times for capital.
Right. I remember laughing about that years and years ago. So, and when did you start Moonshots?
So my partner, Craig Cummings, who's based in Austin, I'm based in Los Angeles. We've known each other since 2005. And we started investing together as angels, old school angel investing, where, hey, Andrew, I really like the business you're running. I'll write you a $25,000 check, and then I'll call 9 buddies to get, $250,000 in. You got $250,000 on you, and that's $500,000. Get an MVP going. We need to do a bridge. Not quite ready for prime time. Let's do that again. And then finally make introductions to institutions, smaller VC funds that'll be able to back it, or bigger VC funds, depending on the scale of the business. But Craig was one of my calls, one of those other 9 buddies. And I was one of his calls when he was building companies in DC while, we were supporting entrepreneurs. In 2014, when Naval at Angel List got a no action letter from the SEC that said you could be a lead angel in a deal and run a syndicate and take carry, and i.e. get paid for the work that you do as the lead angel. I'd been doing it for about 10 years at that point and said, this is fantastic. Let's do that. Let's run syndicates. So we formalized our process around doing these one-off angel deals and started running syndicates. We did that for about 3 years.
And can I ask a question?
Total,
so I knew Naval before, and he had asked me to join, and I look back at it as a mistake. But at the time I was doing Georgetown Angels, if you remember that. And
yeah, sure.
We were charging a 5% one-time management fee and 20% carry, and made the huge mistake of like closing SPVs that we were self-managing for like $20,000. And so the management fee was not anywhere near my accounting bill, which, like, if I were buying cars and boats with my accounting bill, I'd be doing well.
Yeah.
But, some of those were superhuman. So that little $20,000 thing is making me millions. But,
yes.
But Naval in the beginning, and maybe he changed it, but he said, no, there will be no management fee for you. So your only revenue model was carry, which for me, was part of my, scrappy business model.
Absolutely. And, we actually used Angel List for the first 2 or 3 syndicates that we ran. And it turned out at the beginning, and I'm sure it's much more sophisticated and fast now, just with the volume and the sophistication that's been applied. But at the very beginning, it was a little clunky. It was pretty expensive. And we felt like we could operate it faster and easier on our own. Plus I already had angels, right? I had probably 300 or 400 at the time that were following me. And I think now I've got something like 5,000 or 6,000 followers on angels that follow and want to look at deals, but we run them off AngelList, and we've got probably 1,000 on our list now that are active in terms of investing in deals that we show them. So,
okay. And by the way, in your introduction, I skipped over the really Hollywood side of things, that Kelly Perdew is the winner of season 2 of The Apprentice. So we could maybe have a story about that. So it's not surprising that, like, I remember walking down like Sunset Boulevard or something, with you, and people were like walking up to you like you were the mayor. And I was like, how do these people know you? It was a long time ago.
It was a long time ago, yes. There's still, if I'm wearing a suit and tie, which happens almost never, or sitting in an airport for long enough and somebody's staring at me, they think they know me from somewhere. And that's the interesting part of reality television. People are supposed to be acting like they're themselves. That's the reality part of it. So, and I wasn't acting. It was just, it was just me being me in an interesting game show.
That's funny. Okay, so you guys decided we can make our own series LLC and bring this in house and do our own fund admin.
And we've done 45 of them now, right? Since
45 SPVs.
That time started. 45 SPVs that have ranged from, as you were describing, some smaller $100,000 SPVs, and we've gone up to $11.5 million in a single SPV. So it's run the gamut. And initially we were funding those, young companies, entrepreneurs that we really liked. And over the last 3 or 4 years, we've been able to get access to much later stage deals like Slacks and Cartas and Picassos and Robinhoods. And for our LPs, it's very interesting to be investing in kind of the best performing asset class, which is early stage tech, but then also have, the ability to say, hey, I'm in, pick a number, Carta, Slack, whatever it might be. And the return time frame is much shorter because a lot of those were, anticipated to go public and did. And some of them, hopefully still will at some point in time. But compared to, that 2 to 4 year cycle versus the early stages, is kind of, we found from an IPO standpoint, I think the metrics show it's like 9 to 11 year time frame, but our experience has been, it's been closer to 12.
Yeah, and with the evolution of the secondary market, like when we first met, it was my Founders Club days, as you know, and so liquidity has always been on my mind in the secondary market evolving. And now that you got founders taking 20 million cash out of a Series C that's oversubscribed in funds that are too big to function properly, that they are even less motivated to sell the company next year. So if you've been in it, if you've been in that deal for 7 years, the timeline is culturally getting even longer. And I think like we need to start building that into our own strategies.
Yeah, the expectation for LPs is, especially as you do fundraising for your next fund and your next fund, they're like, well, when are we getting money back from that 2 funds ago that we put in? And, I think our syndicate vehicle that we keep alive allows our LPs to, for this, riskier asset class, if you will, that has a higher return, has a shorter time frame for getting, not as big a multiple, but getting some cash back.
Yeah, I mean, sometimes I think of it like we've had, like, our best fund is doing a 15x fund wide return.
That's fantastic. Congratulations.
Which is, I'm being honest, we got lucky a number of times, like lightning hit a couple of times, right? Like this is returning the whole thing. That one's returning the whole one. The one that was almost dead all of a sudden is at a big valuation. But
I love those.
But the thing is, what would you rather have make a 12x return or 15x return over 12 years? And how old are your kids going to be? Like what team is he going to be playing soccer for in 12 years from now? Right. Compared to, can you deliver me a 3x every 3 years? And which one is better? And different LPs.
That's a great question, and I like to describe, because venture capital can appear sexy, and super, big wealth, makes you really, really wealthy. And I like to describe it as a hopefully get rich slow scheme.
Okay.
That's what venture is, right? Because you're not even going to know if you're good at being a venture capitalist for 6 to 8 years out. That's when most acquisitions start to occur. You could, like you said, lightning could strike, or it could be very fast and accelerated. But in anything, notwithstanding perhaps crypto, you really need that amount of time frame if you're investing early stage for a company to evolve, grow, get traction, get attention, and create enough value that another company would want to acquire it.
Well, so I want to focus on strategy and evolution of your thinking around that. But let's just first take advantage of the fact that we've got you here with all of your VC fundraising experience as an operator and now as a VC. What advice would you give to founders that are raising first outside capital, like the very first money coming into the company? What's your
we see 2,000 deals in a year, and a lot of those are completely cold inbounds. A lot of those are also from our founders and or other investors that we previously worked with, that we know we get along with and would like to invest together. And the ones that go right to the front of the line in terms of attention and time and evaluation are those that come in from trusted sources. So the list of companies that every VC has invested in is available. Those founders exist, and in your network, I'm talking to you founders out there, new founders or your first time fundraising founders, you need to find the people that I've invested in. And when they make an introduction, they've done two things, right? They've not only filtered to say, oh, this person can put up with Kelly, right? And how he operates, but, oh, Kelly's probably going to like the way you're operating, or it's in a sector that I know that Kelly operates in. And then that founder, you will also get a good sense of who I am or who Craig is and how we operate together and how we add value. So that when you're asking for the intro, one, it's coming from a warm source. And second, you're more prepared for that meeting, both on what you want to know from us, but also on what it's likely we're going to want to know from you, to see if we can get comfortable with backing you on your
So key advice to the founder: don't be one of 2,000 cold emails coming in. Do the work to network a path to investors so you get introduced. And I agree. There's one of the best intros is through an existing portfolio company that is a domain expert, and
wherever that networking touch point comes from to get to know that one or more of our founders, whether it's shared schooling, you're in the Army, whatever, wherever you can find that touch point. And there are 140 of them, 150 of them now, of people that we backed. And that's one great source. I think that's probably the best one, right? And then there are investors who have worked with us where you're not necessarily the right fit, but you happen to know them, and you could get introduced to us because we do focus on your sector, and or we do focus on the stage of the company where you're fundraising, or whatever the connection might be. But there has to be a reason for it. I think that's probably the most important, to cut through a lot of the chaff. And then second, should that filtering get you to the point where you're meeting with one of us, either our associates or us, the GPs, your origin story and why this is compelling for you and what's going to drive you for your 12 year, right? It's going to be 12 years. So it's longer than average marriage lasts right now. So you're getting married, right? So we're going to have to get along, right? Especially if we're leading and getting the board seat, which is one of the things that we like to do, and probably half the deals that we invest in early stage. But your knowledge of the fundamentals of the unit economics of all of the assumptions that have gone into your model, super important. You can't make it up. It can't be where we push on it and it breaks. You have to have understood it, lived it, know why you're making those assumptions, and be able to defend them. And then I think the final one, there's a lot, but the final one is Craig and I have both, between us had, 14, 15 operating roles. We have bumped our heads. We have fallen in the holes. We have made a lot of mistakes. We do not want to operate your business for you. We're not going to operate your business for you. But we do want to know that you hear our advice. You don't obviously going to listen to it all the time, but we have to know that taking it into account, super important. Now, I do say I told you so when you don't listen to me, and look what happened. But Craig probably doesn't do that as much. But it's important that there's some coachability, right? We have to understand that you're going to be able to hear what we're saying, because it's super important in the selection process. Like it looks like we're really good at picking companies to invest in based on the returns, based on their performance. But I think we're probably better at helping after we invest, so that it looks like we were really good at picking. I guess it doesn't matter at the end of the day, but we do engage, and those founders that you talk to of ours will tell you that we do heavy lifting to help them succeed in building their businesses.
Okay, great advice. So Moonshots, what is the current strategy and how has that evolved? You're clearly doing early stage investing, but you're also fighting your way into assets like Carta at a late stage too.
Yeah, for our fund investments, our primary focus is looking at late seed deals that we can lead. So we're writing $1 to $2.5 million check in a $2 to $5 million round, where we're leading that, putting a term sheet together, helping them ensure that their cap table set up for success, for long-term success for the next round and the round after. And then, we're hopefully getting to a point where we can get, call it 10% ownership, plus or minus 1 or 2%, like to, with the right founders. And then we roll up our sleeves and we help, whether it's from helping to recruit talent, acting as a, mini head of business development for doing intros to the founder, for, setting up, getting those meetings structured and set up for strategic partnerships or customers or client, whatever their client base is for their product or service. And then the hard stuff, especially for the first time founders, it's like, oh, I just got in a fight with my co-founder.
Yeah.
What do we do? I got to hire a salesperson. How does that work? Right? If you've never done that before, that's a sticky wicket, right?
Yeah. What are the words? How is compensation? Like if you're trying to hire, if it's a technical founder hiring a sales guy who's a shark, and he's like, this guy doesn't even know how to build a sales team.
Exactly. And so because Craig and I have operated before and had to do those things, and of course, as an investor, helped other founders through those processes, it's something that we like. I mean, Craig and I do this, like we said, it's a hopefully get rich slow scheme. We do it because we love it. We love the entrepreneurs. It's in our blood. Our DNA as founders still. We haven't completely morphed into the VC side.
Good.
We have a fiduciary responsibility to our LPs, but right up to that fiduciary responsibility, we get the back of those founders, because I know very, very long-term business, you can't screw over founders. That's not the objective. A single deal is not going to, make your brand. And it's just not how we operate or who we are. We were those founders. We were the ones fundraising. We were the ones going through those problems multiple times. Yes. So we get the most joy out of successful execution of one of these founders that has a life-changing event that also returns significant capital to our LPs, right? That's, as you just described, that's what we're in business for.
And what fund vintage are you up to? So 2014 was beginning of SPVs, or did you have a commingled fund?
Yeah, 2014 formalized SPVs, 2017 realized, all right, let's do this. And we raised a $20 million fund one in 2017.
Okay.
We closed 2020, $36 million fund two that we're investing out of currently.
Okay. And so with the current fund, what's the portfolio construction, if you're open about that?
Yeah. I mean, you can see it on our website, but it's half what I just described to you from fund one. And then it's half pretty spectacular opportunities with some later stage deals.
Okay,
For instance, yeah,
50% of the 50% of the fund is going for late seed.
50% of the companies so far in the fund. I think we have 10 currently listed, and there's probably 15 that'll be up there, but within this quarter that we've got signed term sheets and we're closing out on that we'll be able to publish.
Okay, and then 50% are going into
five of the deals are kind of what I just described, early stage, looking for 10%, 1 to 2.5 million first check, trying to leading. And the other ones have been opportunistic, because I'm long in the tooth now of how old and how long I've been around. And we have access to some pretty spectacular deals that, while there's no chance we're getting a 10% ownership, we believe there's still 100 times multiple associated with the deal. And you can look at a couple of examples of those where we invested is Picasso. You might have seen or heard.
Yeah,
of,
that's
right?
the shared. You team up with
LLC, second home ownership via via shared ownership model. So Spencer Raskoff's co-founding chairman, Austin Allison's the founding CEO. Spencer founded Zillow, took it all the way through to public as chairman. Austin was an acquisition. He started a company, was acquired by Zillow. They've known and operated with each other for years in the real estate space. Do you think they know a couple things about getting a company public, growing a massive business? And do you think they know a few things about the real estate space? So this is a, perfect confluence of, this is exactly where you want to be able to invest in a renowned, phenomenal entrepreneur who's operating in their space again, moving fast at scale. So
with a red hot idea too. I mean, it just makes sense. It's a sensible,
awesome timing, right? When people are kind of stepping back from what they're doing and saying, what do I need to do to self-actualize a little bit more instead of work on the treadmill all the time? So it was a perfect confluence of events. And I get the call because Spencer's an LP in our fund. He's participated in some of our syndicates. And he's like, we're closing our second round. Graycroft is leading. And I know Dana at Graycroft. And he's like, we're taking extra capital. Would you guys like to participate? And I was like, how much can I have? Not like,
right.
Maybe.
Right.
It's like, and so we put a portion of that allocation in fund 2, even though it was at a very large valuation. It's only the second finance. This is the Series A, right? And then we took the rest of that allocation and offered it to our fund LPs in an SPV. So wanted it in the fund and did a separate one. The second one that's kind of out of scope from how we would typically operate because of, extra considerations that I think our LPs wouldn't forgive us if we didn't participate, right? I have been an early and every time investor and on the board of a company called ID.me, which is online identity verification. And I was able to get an allocation of primary in Series C, which is a $100 million primary at a $1.4 billion pre-money valuation, slightly outside of our target ownership and range. But everyone in the world wanted in the deal, right? Literally, and for a lot of good reasons. I'm on the board, so I have good information, right? High levels of information. And Craig, my co-founder, has also been, was a seed investor and knows Blake, the founder, is a military veteran. So there are a lot of resonating factors around that, and we still think it's a significant, massive multiple on what it currently is valued at. So we put, we took a million of primary and $1 million of secondary in fund 2 also. So it doesn't fit the, Picasso and ID.me, for example, don't fit the, hey, we're going to put $1 million in and get 10% ownership and, sit there on the board and help the founder and lead the round. But they do represent opportunities that almost anybody would like to have. That's an investor.
When you're investing from the fund, do you have a specific kind of minimum multiple that needs to be plausible? Like I want to talk about valuations later, but valuations got a little wonky in the middle of 2021 where you're like, if I'm coming in at an 80 million pre on,
right,
a company with 900K of ARR and there was nothing 3 months ago,
Yeah,
in revenue. This is not necessarily repeatable.
We
what
like to look at
percentage-
it and have it be plausible. There's no question we could have a 10x.
Okay,
with-
so 10x
with
10x
upside.
for early. What about when you're just saying I want to own Carta and the valuation is big? What like I hear founders saying, "Oh yeah, this is going to be a multi-trillion-dollar company," and I'm like, dude, how many multi-trillion?
There
Are you
aren't a
bigger
lot.
than Saudi
Right.
Aramco? Come on.
Right. So in that instance, that's a perfect example. The valuation was high when we got access, but I also believe that it's definitely, it's the clean acts of what they're doing. Like there is no venture capitalist probably in the world now that doesn't like first or second question during the process of due diligence. You're using Carta, right? To like it's the people who are paying, you're forced into the system pretty much, right? And that data and that connectivity to that equity ownership is something that you can create a flywheel off of in terms of creating additional business models. It's highly defensible, right? Because the switching cost is massive, right? So I believe that could be a big business, but we didn't scratch our heads and go, no brainer 10x from where it was like anytime soon when there's going to be liquidity. So we did all of that Carta investment, still offering the opportunity to our LPs first through the syndicate. So
okay, so you're late. So you want to see 10x on anything coming out of the fund,
correct.
Or are you willing to say I'll take a late stage 4x from the fund to balance out the whole vintage?
The fund has to be minimum 10x, and that's what the LP's thought process is of putting money into that. Think about in terms of that asset class being what that does. Right?
Okay,
so
good.
That's the high risk, high reward. The other opportunities that we get by the nature of who we are and what we've done over time and our relationships is where we take advantage of the shorter time frame, 2x, 4x, 8x, whatever it might be.
What's the minimum?
6.5 million in the grub market.
Sorry?
We just did a $6.5 million syndicate into grub market.
Okay. Yeah, I mean, sometimes, I ask myself, well, why did we do this? It's because we could. Not everyone could, and I did because I can. On some of these late stage.
So I understand the nature of the questions because you're thinking about, okay, discipline and institutional LPs going, where do you invest and how do I think about where you invest? And in some of these cases, it's like, when you're coaching fifth graders in basketball and little Johnny's taking the shot from way outside the three-pointer, you're going, what are you? And it swishes, you're going, great shot. Right? Like yeah. What are you doing? Oh, you got to make it. And, those that are, and also on the later stage deals, we have a lot more data and information. In most cases, we feel like, okay, one, these aren't going to zero because of the nature and the size of the business that's already been built, right? So that's very different than what can happen with a lot of the stuff that's in our fund.
Which is, exactly the way the brain works, because we will invest in a bunch of companies and then they're going through these late stage rounds where everybody wants to be in it now and no one was there with us in the beginning. Valuations are looking a bit big, but the thing is, for us, for our fund, making a 4x would bring down the performance of our fund. Okay.
Well, that's good for you.
So I don't want to
right.
Knowledgeably self-inflict a wound on myself by doing a 4x, but for one of our LPs, if they say, look, if I put money in now, if it sells next year, it'll probably be a 2x. So like you're in it 500 million, it'll with
all on those deals you're talking IRR.
Well, I mean, I'm as I get older, I get less interested in IRR. But where I was obsessed with it because I was like, oh, look at my IRR at the beginning, where now I want to see real DPI distributions. But for some of your LPs to get into something where they perceive a zero risk of it going down and a very strong probability of 2xing next year, that's a good home for $1 million. And if it drags on into 24 months, the way it's going, it looks like a 3x or a 4x. That could be good for somebody.
Exactly.
So what about what's the right amount of diversification to neutralize that late stage seed risk when you're entering at that point? How many companies would you have in one fund?
So for fund one, we're pretty concentrated. For fund one, we did 14 companies.
Okay.
The 20 million, 36 million. We're going to end up, I would say, at like 17 or 18 companies.
Yeah. I think it's good to
Yeah.
have a plan in the beginning, obviously, but as things mature and evolve, you can say like, we've really de-risked the fund because this thing's going to return it. Maybe we can
Yeah.
take a bigger risk on a small check into this thing. You
For
know,
sure.
I mean,
think
you
if
can,
we
you can talk yourself into different things here.
we deploy capital pretty quickly, so there's not that much time to
Watch it evolve.
yeah. I mean, our investment cycle on the 20 million fund one was like 18 months. Now that's the first checks, right? And 2 years in an early stage deal, you're likely not going to be, oh, this is returning the fund, right? I mean, you could on a paper markup, but it's really hard to get that comfort level unless you started to return some cash. And
Right.
Congratulations on your 15x. What's that vintage year?
That is 2016. But an interesting thing I've learned is that if you can hold back until January to make your investments, you get into that vintage.
Yeah, right.
I mean, but I'm not going to do that. But I'm not going to really
Right.
do that. It's like,
Right.
I've got the money. This is Kelly's next startup.
I gotta be in it.
And I'm not waiting to get my vintage to January, and you're taking money now. So, back when you were a founder. So I have a 2014 is fund one, 2016 is fund two, and we're investing out of fund three is where we're at. But
awesome.
So valuations. I mean, you've been around long enough that what was a seed round. Like what was a seed round when you guys were in a coffee shop and you and Craig were pulling together cash? What was the pre-revenue, pre-product valuation in ancient times of the 90s?
We would invest, be able to invest $500,000 to $1.5 million for 10 to 15%, right? 50 to 80 monthly recurring. So you're approaching $1 million in annual recurring revenue, 4, 5, 6, 7, 8. If it's a, moving second time founder, pre-money. And I was going to say you could add a 0 to those now, but that's probably too high. It's not a 0.
That is too high. I mean, like
it's 3x that, 4x that probably now.
Yeah, I mean, a lot of the pre-money valuations for B and C look like bigger than what the exit expectation was for a VC fund. Sure. 300 million on the NASDAQ was a market cap that was like best kid in my MBA class. Very impressive. Whereas 300 million, it sounds like a pre-money valuation almost.
No, round sizes are bigger, valuations are higher. There's more capital available to be deployed, more ways to raise money, faster development of technology, everything. You got, what were private equity funds changing some of the rules for speed to capital in the what was later stage venture capital realm and is now all the way down into seed. You see
I think
Tiger doing seed rounds now. If you're an experienced exited founder, you're pre-money with PowerPoints 20, 30 million.
Yeah, which I don't think is such a great idea because, and I'm not just saying I want to get discounted lower prices and I'm on my side of the table. I just think, and you were kind of talking about this of saying, let's look at what this round was. And I think you said clean up the cap table for success or something like that.
Sure.
Let's say if this goes down now at a 20 million pre of a seed deal, and your Bunsen burner science experiment doesn't really get to the revenue that we thought, and you're going to run out of money with this operating plan, are you going to have an up round on the next funding round? So I think it's good to price today so that the post, the pre of the next round will be an up from the post.
The only thing that makes every single person unhappy, including the existing investors, is a down round. So the warning on any of these deals that seem expensive are, does that amount of capital deployed conservatively on how you're planning to do it with some oopses and, pivot one, like it happens to even even the best founders, right? Have you accounted for enough of those in your assumptions that you're going to get operating metrics that are going to allow you to do an up round, including if the market dynamics change or shift?
Yeah.
Right. And that's how we've approached everything. So we lost no companies due to COVID.
Okay. We lost
from Fund
Domio.
One.
We lost one. It's basically in the hotel business, but they should have just stopped paying and said, we're going to rev share
that's a tough one.
our way through this.
The company that we did shutter prior to COVID had already started an M&A process. And it did eliminate the chance of M&A, but the company was already in the process of selling the IP when COVID hit and shut everything off. But it wasn't a, oh no, we're going to run out of cash. We tried to, especially in those seed deals, look at it for, you can need 18 to 24 months of runway. You're at 50 to 80K of monthly recurring that you can grow, so that the idea is to have the founder not have their outcome be 100% dependent on another round of venture capital. Like if push comes to shove, you hit a nuclear winter, are you able to be in control of your own destiny without relying on outside capital?
I mean, I think it's
18 to
nice.
24 month time frame.
It's nice to see a runway that could potentially tip the company into profitability. And if you're the founder, it is good to not be addicted to the drug dealer of their money, and being forced to take that. There's no question about that. So you guys originally had a certain veteran part of your thesis that you're going to back, military veterans, and that's obviously really changed. Maybe give the quick and I think we both have a call we got to jump on. So this is like 2 minutes, 3 minutes.
Yep. No problem.
What is the quick investment thesis on sector? We understand stage, geographies, what, just post US or pan US?
Yeah, we've been currently only US so far, in terms of all the companies that we've invested in. Our thesis is, and our focus is, Craig and I both being military veterans, both had millions of dollars spent training us in leadership and us training others in leadership. We're looking for extraordinary leaders for these early stage deals, because the one thing that's been true across the 100+ companies that we've invested in is that early stage, none of them end up where they were aiming originally, right? They hit market conditions, they hit competitors, they, product demands, customers want something different. Oh my gosh, whatever it might be. And so there are pivots that require significant leadership capability. So we're looking for extraordinary leadership. Of course, we default and look at military veterans. About a third of our AUM is into deals that have military veterans as part of the founding team. They've had millions of dollars spent training them in leadership per se. Now, who else has phenomenal leadership chops? Or the stuff that we like to look for, Division I team athletes, people who've been through extraordinarily difficult circumstances. Our Fund One makeup is got 85% what we call non-traditional founders, right? Military veterans, people of color, women, you name it, right? And Craig and I didn't go out and target that audience, right, in terms of wanting to invest. The military veterans, we definitely market that. We want to see anybody that's got a military veteran on the founding team, high speed to trust, shared common background, nomenclature, you name it, right? In those deals, it's possible you trust your lead investor as much or more than you trust your co-founder because of that shared background and the background checks, against former company commanders or teammates or whatever it might be. But the reason we think, when we look back at it, that we had that many non-traditional founders as part of the makeup of Fund One, and it looks like Fund Two will be the same thing, is if you were able to kind of make it through all the challenges and obstacles to get to us with a company that's approaching $1 million in annual recurring revenue and be in front of us pitching, as a woman, as a person of color, you've got the grit, determination, and leadership chops that we like and resonates with us that we see in the military veterans. So if there's a demonstrable, leadership capability that we can look at and see and get our hands around, that's the first thing that we look at. And of course, we have sectors where we've operated. that, are listed on our website. But that's the gist of it. We really have to basically fall in love with the founders. Obviously, large addressable market, want to understand that you know what you're doing, but it really is about the leadership traits of the founding team.
Great. Well, Kelly, great to see you. Thanks for the time. I was psyched when I saw you in John Vitti's Versus game. So that's one that we both did.
Shared.
Yeah. We both share, and look forward to that good outcome together and many more.
Awesome. Thank you for having me today, Andy.
See you now. Bye for now.
Take care.